Let's look at the agricultural business because something really huge is happening there right now. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. We go here to the consumer's defensive sector, and the ETF in question is the VanEck Vectors Agribusiness ETF. MOO is the ticker. 79% here from the low and basically at all-time highs. Okay, here is the chart. The thing is that we are seeing inflation in many different asset classes. So across the board, prices have gone up. However, there is a certain industry where people are very sensitive to inflation, and that is food prices. So people are okay with stock prices going up, okay with Bitcoin going up, even though the reality is that the most wealthy people benefit the most from those increases, but still there is this complacency about that. But when you go to the store and you see that food prices and beverage prices are going up, that is a way more sensitive topic, and we are seeing that right now. There's been a huge boom in commodity prices, especially agricultural commodities, and food producers are now reacting. And this will be a big deal. So far, we have not had politicians come out and try to really regulate these price increases. But I think there's a very high probability that that will happen, and that will be bearish. Very much so. So this is the MOO ETF weekly data points and all the data we have here. When we look here at the PPO, which measures the distance between price and the red 200-week moving average, we have never been this far away. Like, never. When we look at the RSI, the only time where we had a higher RSI is back here with this pink arrow. That major peak was followed by a very messy time for the Agribusiness ETF. We went all the way down here to test the red 200-week moving average before we really could rally again. In this event, where we had a similar RSI level to now, we had a little bit of a pullback, but nothing big. But the rally we had before that was, it was minuscule compared to what we have now. So the context definitively matters. Looking at this event, then we did have a substantial correction to the 200-week moving average. This event here, the 200-week moving average, and in this event we test the blue 100-week moving average. Hence, historically speaking, this current setup represents high risk for bulls. Are the bulls still in control, yes or no? Obviously they are. However, this is a very risky situation. It's around here that it makes a lot of sense to become very bullish, because you could make a strong case of significant upside. At these levels, with okay, let's remove the notification. When it is this overextended, it is easier to make a case for a downside than upside. But let's explore further. Let's go here to the daily data points. If we look here at accumulation distribution, we are seeing that it peaked around here. So here is where accumulation peaked. And you see that the most recent rally, it has definitively been, objectively speaking, on much lighter buying momentum. When we look here at the PPO and the RSI for the daily data points, we do see, risk signals RSI doesn't really like to be overbought. It has a strong tendency to test the lower end of the RSI range. The PPO we currently have is just super overextended. So if we look at some prior rallies, you can see that during this rally, the blue 100-day moving average was tested rather frequently. It was a key support level. During this rally, we do rely more on the 50-day moving average in green, but that was followed by a more dramatic pullback than what we had here. If we fast forward, here we test the blue 100-day moving average, so that is a key support level, and when we do have a correction, it was, more modest. You had a lot of time to really get out of your position, to look for other opportunities, as an example. So this is a correction, but it didn't really accelerate to the downside until much later. And part of the reason is because we did use that longer term moving average. The market participants, they were in a different frame of mind, much more rational. But what is happening now compared to the previous events? Well, in this instance, we did test the blue 100-day moving average a little bit here, but basically the primary moving average we have relied on is the green 50-day moving average. Judging by the history, that is one of those moving averages that can create problems because they distort the market psychology. Looking at the seasonality for MOO, we are technically speaking currently in April. Now there's a few days left. So this is recorded on the 27th of April. However, you can clearly see the seasonality yourself. May is, meaningfully weaker. There usually is a 0.6% gain, but June is the weakest month. Hence, the probability of a correction is significant. Looking at Finviz, we have been in this range, and we have so far been rejected when we touch the upper part of the range, but so far not any substantial pullback. When we compare the S&P 500 with the MOO ETF, if we look at the price-to-book ratio, the price-to-book is higher for the S&P 500. Dividend is higher for the S&P. When we look at the price-to-earnings, then the price-earnings for the MOO ETF is 114% higher than the S&P 500. That is significant. Here you can see the breakdown of the MOO ETF, the countries, the top 10 sectors, top 10 holdings. So to sum up my take here for the MOO ETF, looking long term, you could make a very strong case that we are highly overextended and that there's a substantial risk that there will be uproar when it comes to food prices increasing. That is something people are very sensitive to. So yeah, you could certainly make a case for downside, but so far this one has been tricky to go bearish on. There's been a lot of bears that have tried and then get stopped out and have to cover. But at some point, the most difficult bearish trades become the best bearish trades because the asset is simply obscenely overextended in one direction. Looking at the short time frame here, the daily data points, then again, it is a similar message. We are just very overextended in one direction, and there's a high probability that this will become a political issue, and that will be bearish.